Hello and welcome back. All right, continuing on our discussion of competitive advantage. I want to now combine some of the insights we've had so far to define what I consider to be sustainable competitive advantage. Up to this point, we've really focused on competitive advantages. I'll review that momentarily. But what we care about when you start to think about the long-term value creation of a company or their long-term sustainability of their earnings power, that earnings power value, and then we'll show, but you start to think about growth, critical aspect of the analysis is do they have a sustainable competitive advantage? Not just a competitive advantage, but one that has durability that they can protect over time. So I want to bring a couple of things together in this lecture to really define what that sustainable competitive advantage is. All right, here's been the challenge we were talking about is company has scale. They're well down on the scale curve, so their average cost is well below their price, which leads to excess returns. And those excess returns are going to attract competitors, always will. There's always going to be somebody who's going to try to get into the business. The most common strategy to enter a business is lower price. It's not the only strategy. But it's really the classical way you want to think about it. And it is a good tool for us to think about the various pieces. All right, so competitor enters the market. What we talked about in the last couple of lectures is that the incumbent has to respond. They have no choice. If they don't respond, then the challenger could get into the market, start to come down the average cost curve, and become a more formidable competitor over time. If they do respond, they have no choice to respond, it will affect the incumbent's profitability, maybe not by much, but they have no choice. They have to keep the competitor at bay. So you start to realize that even the threat of competition puts pressure on companies to watch their pricing, because if excess returns get too big, too high, you're going to attract competition. Competition's going to try to enter the market. And as the incumbent, you have no choice but to respond. Now, we're going to change the analysis slightly momentarily. All right, remember that our sources of excess returns are higher prices, lower costs, or more efficient use of capital, scale. That's what we're really talking about. And on the demand side, that higher prices, that customer who's willing to pay a higher price for the product, is what we would call a demand side competitive advantage. It's really a customer facing advantage. All right. Simplest terms is we think of that as customer captivity. Customers are captive for one of various reasons. But the key is that customers not looking for a change or replacement. They're not that receptive to it. Either, habit, price is not a big factor. Switching, it's hard to switch, or search, price is not the driving factor in the decision. So we call this customer captivity. Customers willing to pay a higher price for the product than they would in a competitive market. And for me, it's kind of the customer's generally happy. They're happy with their decision. They don't feel like there's a big upside to changing their decision, and they're somewhat insensitive to price competition because price is not what's really driving their decision, and that's key. So we talked about this, Bruce's work, customer captivity being the key part of that, and he talks about three, but customer captivity I want to focus on now. We mentioned this once before, Seth Godin's definition of brands, and I talked about brands are a secondary force. The primary forces in my mind are really Bruce's three driving factors. But brand value is the key here. It's not brands. Every marketing professional wants you to believe it's a brand. No, it's brand value, which is the key. And the way Seth defined it, which I absolutely love, is if the consumer, in this case, that could be a business, a buyer, a voter, or a donor, doesn't pay a premium, make a selection, or spread the word, then there's no brand value exists for that consumer. So let's assume for a moment that the company has a relationship with the customer in such a way that they have some sort of captivity, customers not being sensitive to price, or in Seth Godin's world, there's brand value. And we combine that with scale. Now we get into something that I think is really interesting. All right, so now we're looking at this scale model again, but this time with customer captivity. The customers are generally happy. They're somewhat insensitive to price. Price is not a big factor in their decision making. And the incumbent has scale. So we have two factors here, two of Bruce's factors, customer captivity and scale. Now, competitor enters the market. We'll stick with the traditional strategy of lower price and more aggressive price. Now, does the incumbent need to respond? Remember, when we didn't have customer captivity, the incumbent had no choice but to respond. By not responding, they're creating an opening or an opportunity for that competitor. They had to respond. But now, if we layer in customer captivity, the customer is not that price sensitive. Their decision's not being driven by price. Why, then, does the incumbent have to respond? And I will argue they don't have to respond, at least in terms of price. Now, they may respond with other things. They may do a frequent sleeper program, buy 11 months of service, we'll give you the 12th month for free. Buy a year worth of product, we'll give you service for free. I mean, they may do some bundling to kind of reinforce their position in the market, but they're not going to respond with price. They don't have to. The consumers are not being driven by price. That's not the primary factor for getting them to change their mind. So now, if we start to think about this, the incumbent in this situation has customer captivity, that generally happy customer, plus the economic benefit of scale. And to me, those are the two reinforcing forces that we need to start to build a case for sustainable competitive advantage. So my definition of sustainable competitive advantage, think about that as the durability of the competitive advantage, is a combination of, I'm going to cheat, three things. I said two, but it's really three. Customer captivity, happy customers. Customers generally not being motivated, their decisions not being motivated by price. And I've drawn this with scale, but it could be a proprietary production process or service delivery process, or scale. So we have some sort of hard to replicate economies of scale. I have an economic advantage, or you could have a proprietary production or service delivery process. I need both of those: customer captivity, generally happy customers, customers not feeling any need to change, and one of two things, either scale or some sort of process that's very difficult to replicate. Those are my two primary drivers of competitive advantage. They become reinforcing. And then on top of that, you need constant vigilance. That's my phrase. Constant vigilance is the idea that management is focused on maintaining, reinforcing, trying to improve upon these two primary competitive advantages. When they come together, customer captivity and scale, or customer captivity and proprietary production process, that is sustainable as long as management continues to reinforce it. So that's my definition of sustainable competitive advantage: customer captivity, happy customers, either scale or a proprietary process that's very hard to replicate, and then a management team that reinforces those two forces. That's it. That's it. That, to me, is sustainable competitive advantage. All right, you can do a competitive advantage audit when you find yourself. So the first thing you do is, if there's evidence of competitive advantage, which is excess returns, then you ask two questions. One, does the firm have captive customers, habit, search, or switch? And if not, then the source of competitive advantage must be scale or proprietary service delivery process. So that's how we sort of know if you don't have that. So when we look at companies that have excess returns, if they do not have customer captivity, by definition, then their source of competitive advantage is scale or proprietary production or service delivery. However, it's hard to maintain that. We already talked about in the prior lecture that having scale alone does not deter competitors from trying to enter the market. So it's really that combination, which I think is really important. All right, so the question of sustainability in this analysis is very simple. How hard will it be for the competitor to replicate the scale or process service delivery and enter the market successfully? So I need both of those. I need that customer captivity. I need that customer that's kind of unwilling or doesn't feel a need to change. That, I think, is really, really important. All right, so what should management's focus be? I would argue internally, it should be continuous improvement, focused on both keeping those customers very happy as well as reinforcing that scale position or reinforcing that proprietary production or service delivery. Externally should be continuous, meaningful innovation that encourages or reinforces the customer's willingness to pay. And that's really where management focus should be when it comes to competitive advantage, particularly sustainable competitive advantage. Now, constant vigilance. Let me flesh that out for a moment. Number one is, and I think you want to think about this, does a management team correctly identify the sources of its competitive advantage? I mean, very few management teams that understand their source of competitive advantage. I hear a lot of things like my people, my brand, my relationship with the customer. Those are not competitive advantages. Those may be true, but they're not. All right, number two is make defending or enhancing these competitive advantage a priority, right? Number one, you understand what they are. The management team understands what they are. And they make defending or enhancing these competitive advantages a priority. That's strategy, in my mind. And then I think it's really important, maintain a culture of operational excellence. Execution enhances all strategies if you can execute well. And then I think this is the key fourth piece, which is this is my definition of constant vigilance. Fourth piece is successfully communicate the corporate strategy to all employees. I met very few management teams that do this, but to me, this would be what I define as constant vigilance. And you can use this as a management checklist, right? Do they correctly identify the source of competitive advantages, right? Do they make defending and enhancing these competitive advantages a priority? Do they maintain and work very hard at maintaining a culture of operational excellence? Do they successfully communicate the corporate strategy? So for me, this is a management checklist around strategy. This is, to me, the definition of that strategy. All right, we've defined sustainable competitive advantage, 3 pieces: customer captivity of some kind, happy customer. Number 2, a scale or proprietary process that's hard to replicate. Bringing those two together make effectively very high barriers to entry and can make it sustainable. And then that last layer, management recognizes their competitive advantage and is focused on maintaining that and delivering that. All right, let me walk through a couple other considerations that you want to think about. Number 1, is growth good for competitive advantage? Now, a lot of people say, yes, it must be good for competitive advantage. The answer is no. Fast growth creates new customers. New customers do not have captivity. New customers create new opportunities. New customers create opportunity to create scale. So that's what's really important. So be careful. Fast growth does not, it can destroy a competitive advantage, believe it or not, sort of counterintuitive. One exception would be platform companies, which is what we'll talk about in the next lecture. All right, remember, these new customers that you're creating with this fast growth have no loyalty. There's no captivity. So I'm losing that. Now, I think, this is my rule of thumb, is modest growth, less than 10%, can be managed. Higher growth, greater than 10%, allows competitors to enter the market. And once that growth slows down, which inevitably it will, those competitive pressures start to show themselves. So be careful about growth. High growth, I think, is actually dangerous. It's great during the high growth. It's when that growth slows down, and we'll talk about that more in the growth lecture. That's the key. Then competitive pressures really start to become an issue. That industry structure is going to be tested. All right, international markets, globalization. Is that good for competitive advantage? A lot of the CEOs of U.S. companies said, look, we're really terrific in our market in the U.S. We're going to go to another market, international globalization. I would argue, no, it's bad for competitive advantage, right? Number one, larger markets support many competitors, and you have something called minimal viable market share. I'll talk about that momentarily. And local franchises are almost always more profitable, and that's the key. Scale and consumer behavior are often geographically defined. The markets in Europe, there is no Europe, by the way, it's a collection of countries, they call themselves Europe. All of those norms, business norms, tastes, cultures, all are different as you go across the continent. So you can have scale in one market and not in another. So I'd be very careful about international or globalization. If it's a global market, there's going to be too many competitors. There are a few exceptions, but I'll explain what those are momentarily, but be careful about that. Local franchises are more profitable. Amazon breaks even internationally. It took Walmart 25 years to get to the level of profitability outside the U.S. that is in the U.S. The return on equity for McDonald's is 2x inside the U.S. as it is outside the U.S. HSBC makes all their money in London and in Hong Kong and breaks even everywhere else. Benetton makes all their money in Europe, breaks even everywhere else. You can just go on and on and on and on and on. Be careful about globalization market. Now, be careful of large total addressable markets. I hear this from companies. We're going into this market because it's so large. Here's the real test. You want to think about this as what they call minimum viable scale. At what point? So let's just say that the average cost curve in an industry, this is autos, by the way, that 10% market share, you're at scale. And that's the problem with the auto industry is that, guess what? You could build a very efficient factory at about 350,000 units a year. But we sell 90 million units across the planet. You could 30 production plants are all at viable minimal scale. I mean, you can support too many companies. Right here, if the minimum viable scale is 25% market share, this is more interesting. You end up with 4 vendors. The best businesses look like this. And then the ideal is that you could support 1 vendor at scale. This is those platform companies, which I'll talk about in the next lecture. We'll see. All right, next one, M&A, good for competitive advantage. No, bad for competitive advantage. Companies say this all the time. We're acquiring this company to enhance our competitive advantage. It won't happen. All right? It rarely creates or enhances a competitive advantage. The only way you want to think about it is if the acquisition makes the customer captivity stronger, rare but possible, or if it helps on the scale. That's it. Otherwise, it will not create value. Be careful about M&A. And you can only create value where you have a franchise. We talked about this. You can only create value where you have excess return on capital. But you always overpay. Remember, it's a winner's curse. The winner gets the bid. So be very careful about that. And then most companies do an absolute poor job integrating the acquisition after the transaction. So you got kind of three things, I guess, 3 strikes for M&A. 1, it can't buy competitive advantage. 2, they often overpay. 3, they usually do a terrible job of integrating. So no M&A. That's the key. New technologies or product obsolescence, good for competitive advantage? No, absolutely not. It's like a universal asset in its ability to destroy great franchise. When the internet came along, really in full commercial, 25 years ago, maybe more now, closer to 30 years ago, all the media companies said, this is great for our business, new market opportunities, new growth opportunities. When in fact, what it did is destroyed a lot of businesses. And that's always the case with new technologies. They reset the game. So be careful about that. So all of these, I think you want to be careful. High growth, international markets or globalization, M&A, and new technologies. Those almost always are bad for sustainable competitive advantages. All right, and then one more, rivalry. You want to look out for price competition between established vendors, right? So if you have barriers to entry, that keeps new vendors out of the market, but it doesn't keep price competition among current vendors. So it's easy to destroy a good business, very hard to build a good business. So watch out for rivalry. And Porter talks about there in this talks about this in his 5 forces, and I think it's important. The test is often low variable costs, so that incremental customer tends to be more profitable. Low differentiation between products, so low customer captivity, and often management ego. The U.S. airline industry is, for many of its years, has really had rivalry be a real problem. Low variable costs, somewhat undifferentiated products or services, and for whatever reason, a lot of egos in the airline industry. So be careful of these outside forces that can actually destroy businesses. Rarely do they enhance, often they destroy. All right, so what's the valuation implication? We've talked about this. When your return on capital is greater than your cost of capital, your earnings power value is greater than the invested capital in the business, but you're also going to attract a lot of competition. If your ROIC equals your cost of capital, guess what? Earnings power value is equal to the invested capital. Not very interesting. Return on invested capital is less than your cost of capital, then the actual cash flow value of the business, the earnings power value, will be less than the invested capital. And here's sort of the challenge. As your ROIC on the left comes down over time, guess what? Your earnings power value comes down over time. Those excess returns go away, and the value of those excess returns go away. That should make sense. Well, this is what it looks like. We go back towards the Italian cookie. And that present value competitive advantage is declining over time because guess what? Competitors are successfully coming into the market, lowering price, stealing customers. And the incumbent, guess what, has to respond in terms of price. And then as they lose market share, they come up that average cost curve and their return on capital goes down. That value of that business slowly approaches invested capital. There's no value to those excess returns. There's no value to that competitive advantage because it wasn't sustainable. So to maintain that blue layer, to maintain that excess, the value of those excess returns, it's got to be a sustainable competitive advantage. That's why this whole lecture ties up together. All right, this is our chart. This is the Italian cookie where we have that blue excess returns. That attracts attention and competition. If the competitors are successful entering the market, it will drive down profitability and returns and destroy that layer of value, which is really important. Well, guess what? Your market implied value of growth is on top of the blue layer. Without a blue layer, there's no value to growth. I'll explain that as we get to growth. The good news is we're getting closer to the growth lectures. We have a couple more competitive advantage lectures, and then we'll dive into growth. The reason we have to do competitive advantage is for two. One, we've got to have, if you don't have excess returns, there's no value to growth. Explain that in the growth lectures. And two, if you cannot maintain, not you, but the company cannot maintain that layer of blue, those excess returns, guess what? Incrementally, growth is not going to have much value, and it's going to collapse on itself. So we're starting to build up this valuation stack, the lowest layer. We've not talked about that in this lecture, is your invested capital. That next layer is excess returns, present value, competitive advantage. And then growth gets layered on top of that. If the company cannot maintain blue, over time, there will not be value to growth. And that's the key here. And the way they maintain blue is they have to have a sustainable competitive advantage. My world, my definition of sustainable competitive advantage is happy customers, some sort of customer captivity, some sort of scale or proprietary production service delivery that is hard to replicate, and the combination, and then a management team that understands the sources of the company's competitive advantage and that constant vigilance, making sure they're reinforcing those competitive advantages over time. All right, we're getting closer to the value of growth, which is exciting. We need to talk about platform companies and a couple other things, and then we'll dive into growth. So a couple of lectures away. All right, thank you.